Well, good morning, everyone. Today is January 15th. January is, depending on whether you appreciate 31 days in a month or not, it's about halfway done. Can you imagine the first month of the year is already halfway done? I don't even know where the time goes. I honestly don't. Anyways, let's talk about markets. We had the CPI came out yesterday. As I mentioned, not anything important, nothing right in the middle of expectations. We got the PPI coming out. So the CPI came out yesterday, PPI is coming out today. Again, not expecting anything major. The big number this week is going to be retail sales, obviously jobless claims, and industrial production. Housing starts too, but housing starts have been softening, so I'm not expecting anything major there. But retail sales and industrial productions are going to be important. Now, why is retail sales important? Retail sales make up 70 to 80% of the GDP. Target, earnings are in full effect, folks. Target did not have a Merry Christmas. Sales were below previous year. Numbers were not solid. Yesterday, bank stocks started. So right now we're looking at some retailers and some bank stocks, mostly bank stocks, and the numbers are mixed. I was talking to my group about expectations yesterday, and the expectations went from being positive in October for revenue quarter over quarter from a year ago to down 3.7%. So revenue expectations are lower. Now, first quarter, next quarter, we are expecting positive earnings and revenue across the board, but it could be changed. Now, so far, the numbers are softer than expected, all right? And here's what we have on the table today. We got Bank of America, big bank stocks. We got Goldman Sachs, and we have, there's one more big one here, US Bancorp. These are the three big companies that are coming out today. I would pay close attention to comments from Goldman Sachs and Bank of America, especially Goldman Sachs, because Goldman does a lot of investment bankings. I will report tomorrow on the outcome and tell you what's going on. Now, just when we thought US and China were making friends, becoming friends, I want to read something important to you, and this is really, really important. Pay attention. Markets have regained upwards momentum due to China and US sign a preliminary trade agreement on blah, blah, blah. But get this, concern over whether the deal will stick overshadowed the optimism after US Treasury Secretary said the deal will not reduce any punitive tariffs imposed on imports from China until after the two sides reach a full agreement. All right? And that may take a while. So things are not as the US and China trade war is like watching a live show in the theater of the absurd. Actually, funny enough, I didn't see that comment, but I was about to say something very similarly to that. So we're getting some shakiness, and this is not positive. Now, in terms of momentum and how does the technicals, I just gave you the fundamentals. How does the technicals fall into all of this? Well, this is the S&P 500. This is the percentage of stocks in the S&P 500 trading above the 200-day moving average. I want you to see what happens here. This is 5 years. Every time we go above 80th percentile, we move down to the 50th. Basically, every time we move to this level where we're at right now, the S&P takes a nice snow dive and takes us all the way to the 200-day moving average, which is still bullish unless we go down to here. That's a little bearish, but it bounces back. This is what happened last November. So I want you to see what happens, and the market does bounce back. But we are in nosebleed levels right now, and the odds of us sustaining these levels are not that good. As a matter of fact, they're poor. As a matter of fact, the odds are by the time we're done with these earnings, the percentage of stocks trading above the 200-day moving average will move from 80th percentile till about 50th percentile. And no, I don't have a crystal ball. I'm just looking at the last 5 years. And if you look at the last 20 years, look, every time. How long do you see it stay here? Not very long. So we're in nosebleeds. Again, we may stay around these levels for a few more months, but the bottom line is that's like getting into a market where that rubber band is stretched out like this, and hoping it'll stretch further. Not a good idea. The odds are much stronger it'll contract and then spread out. So to give you a little review, jobless claims, retail sales, and industrial production are going to be the big reports this week. Jobless claims, Fed employment data is 60 years, stronger than it's been in 50 to 60 years. So I'm not expecting anything major there. And the long bond has already made up its mind. It's already moving higher. Fed's lowering rates, long bonds moving higher. What am I trying to get at? If you have an adjustable mortgage, it's going higher. Your interest rate is going higher, even though the Fed made the last two rate drops. So the long bond is already assimilating higher rates. Again, everything I'm saying right now is not pointing to a terrible market or a bear market, any of that. All I'm saying is the market is a little overstretched and the bonds have begun appraising rates moving higher. Hope that helps. Now, I got something really big for you, something important. So I know a lot of you are looking for big gains in January and February and March of this year, especially with earnings season on the table, but large caps are overbought. What do? Well, I got something good for you. Imagine making 50 to 100% return on stocks, not options, over the next 30 days. It's very possible. And again, no options. Whenever I say 50, 100, 200, 300%, everybody's always thinking options. It doesn't necessarily have to be that way. I have a strategy. It's very aggressive. It's called the Cyborg, and it trades smaller companies, companies that 99% of you are completely ignoring, all right? Completely ignoring. It's a mistake. If you add these companies to your portfolio with a little bit of diversification, we're talking huge returns, and the diversification gives you a wall of safety. You really want to find out about this. This is something I couldn't recommend more to add to your account in 2020. Get all the details, learn how the Cyborg system works, follow the link below, do it now. Now get this, the training session that I have online, it's coming down in 24 hours. Check it out now. Again, no options, smaller companies, complete diversification from large cap stocks, overbought 200-day moving average, doesn't matter. Small caps have been sitting on the sidelines. They've been congesting. They've been just sitting, waiting for a breakout, and they're a lot more speculative, which means they have a lot more upside potential than large cap stocks when large caps are in the nosebleeds like they are right now. Folks, 80% of stocks in the S&P 500, that's over 400 stocks, are overbought right now. Small caps are not. Large caps have been moving up. Small caps have been moving sideways. And finally, when Trump and China began figuring this trade war out, they began moving higher and higher and higher. And the best part, they're not correlated to large cap stocks. Small stocks, no correlation, no options, small account friendly. You can use clusters, which I show you in the training. I can't say enough good things about it. If you're a savvy investor, then you will add Cyborg to your account in 2020, and the difference it'll make is going to be uncanny. I can almost promise you that. I can't predict the future, but I can almost promise you that. To have that level of diversification from the S&P 500, to have potential for big gains without using options, there's nothing like it. Follow the link below. The video, the training, it's coming down in 24 hours. Don't miss out. Start off this year on the right note. We're already 2 weeks into the year. What are you waiting for? Do it now. Follow the link below. Talk soon.